They broke the system. Imagine walking into a store in China and buying silver for just $86, while back in New York, the same silver is being sold at an outrageous price. Today, we were exposing why the New York market numbers are a total lie and what this means for anyone who has ever bought or invested in silver. From hidden market manipulations to the global supply tricks, the truth is shocking, and it could completely change the way you see precious metals forever. But before we dive in, a quick disclaimer. This video is for informational and educational purposes only and does not constitute financial advice. Always do your own research before making investment decisions. Stick around, because we're breaking down exactly how these prices are manipulated, why China's silver market is a game changer, and what it could mean for you if this trend spreads worldwide. If you think the silver market is fair, think again. This might completely blow your mind. By the end of this video, you'll never look at silver prices the same way again. And if you want to see more insider truths like this, make sure to smash that like button right now. It helps us bring more eye-opening content straight to you. When most people hear the word silver, they think of jewelry, coins, or maybe a small investment tucked away in a safe. But the truth is far more complex and, frankly, shocking. Imagine this. In China today, you can buy physical silver for around $86 per ounce, a price that would seem absurdly low to anyone checking the New York market. In New York, the exact same silver is being sold for almost double, or even more in some cases. How is this possible? How can one country's market produce silver at one price, and another, ostensibly free market, charge an entirely different rate for the same asset? The answer, as it turns out, isn't just economics. It's a mixture of market manipulation, currency discrepancies, and a little understood global supply chain that few people truly grasp. Most investors are fed numbers from Wall Street or financial media and accept them as gospel. But once you start digging, you realize the story is completely different. The New York price for silver isn't just high because of demand. In many ways, it's artificially inflated, a product of derivatives, futures contracts, and global trading systems designed to favor certain players. Meanwhile, markets in China operate on a different logic entirely, often closer to the actual production cost of silver, stripped of speculative bubbles and paper contracts that dominate Western exchanges. Consider this. The global silver market isn't as large as gold, yet it's highly leveraged. Millions of ounces trade daily on paper contracts, but the physical supply, real silver in vaults and mints, is far more limited. When you see a New York silver price spike, a large part of that increase reflects financial instruments and futures contracts, not the tangible metal you could hold in your hand. In contrast, when a Chinese investor buys silver, they're often purchasing the physical commodity directly, often at or near production cost, which explains the massive price discrepancy. What's more, currency dynamics play a critical role. The Chinese yuan, controlled by the People's Bank of China, behaves very differently than the US dollar, especially during periods of inflation or global economic uncertainty. When the yuan strengthens against other currencies, it effectively reduces the domestic cost of imported commodities like silver, allowing local buyers to access prices that would seem impossible in the West. The US dollar, meanwhile, is heavily influenced by Federal Reserve policies, interest rates, and market speculation, further inflating the apparent price of silver in New York. And this is where it gets truly interesting. If $86 silver is available in China today, that doesn't just represent a bargain, it represents a crack in the system, a hint that global silver pricing is not what it seems. It's a window into the mechanics of international finance, where the numbers you see on the ticker might not reflect the reality of supply, production, or even demand. Investors who recognize this discrepancy early have a significant advantage because it reveals the potential for arbitrage, hidden value, and market disruption. But let's be clear, this isn't a simple buy low, sell high story. Understanding why China can sell silver at such low prices requires diving deep into the interplay between industrial demand, government control, and speculative markets. Chinese refineries often operate with lower margins, less regulatory overhead, and a focus on physical metal accumulation rather than paper trading. This contrasts sharply with the United States, where much of the market is dominated by futures, contracts, and ETFs, tools that can push the price far beyond the actual physical value of silver. By now, you might be asking, what does this mean for you? For one, it means that the silver market is far more manipulable than most investors realize. Prices you see in New York are just influenced by supply. On in demand, they are affected by hedge funds, institutional players, and government policies that can distort the market for profit. Meanwhile, the real price, reflected in China's market, tells a story that's often hidden from the casual observer. Those who understand the discrepancy can anticipate shifts in global pricing, potentially protecting themselves from overpaying or identifying strategic investment opportunities. We're only scratching the surface here. In the next segment, we'll explore the historical context that led to this divergence, diving into decades of policy decisions, market manipulations, and international tensions that created this massive pricing gap. From the collapse of certain Western silver exchanges to China's steady accumulation strategy, the story is far more intricate and far more fascinating than anyone realizes. Before we move on, here's a reminder. This video is purely educational and informational. I'm not giving financial advice. Every investor must do their own research before making decisions. That said, what we can't be uncovering is crucial knowledge for anyone who wants to understand the silver market on a global analytical level, especially if you want to think like an investor, not a speculator. To truly understand why silver in China can cost $86 while New York S price seems outrageously inflated, we have to step back in time. The silver market isn't some static natural phenomenon. It's the product of decades of global policy, economic manipulation, and evolving financial systems that most people don't even think about when they glance at a commodity ticker. Let's rewind to the 1970s and 1980s when the modern silver market began taking shape in the West. Back then, silver was a highly coveted industrial and monetary metal, much like gold, but smaller in scale. This is when futures contracts, ETFs, and derivatives started gaining traction in New York and London. These instruments promised liquidity and the ability to profit without ever physically holding silver, but they also introduced a dangerous side effect: the decoupling of paper prices from physical reality. Suddenly, you could speculate on millions of ounces of silver that barely existed in the vaults. This trend accelerated in the 1980s with events like the infamous Hunt brothers' attempt to corner the silver market, which temporarily drove silver prices to over $50 an ounce. But when the market crashed, the fallout exposed a major weakness. The West AS silver pricing could be dramatically influenced by speculation, derivatives, and market psychology, rather than supply and demand. That lesson was never forgotten, but the systems that allow for manipulation remained and in many ways became more sophisticated. Meanwhile, China's story was entirely different. For decades, China's silver market was relatively isolated from global speculation. Physical silver was mined, refined, and distributed largely within domestic channels, often with government oversight and industrial demand as the primary drivers. China focused on actual metal accumulation, not trading paper contracts or futures. This approach allowed the domestic silver price to remain closely tied to production costs, unlike the West, where Wall Street's influence could push prices far beyond reality. Fast forward to today, and the contrast is striking. In New York, silver prices are largely driven by the COMEX futures market, ETFs, and speculative instruments. The real, tangible silver backing these contracts is a fraction of the notional value traded daily. Meanwhile, in China, buyers are paying prices that reflect actual metal availability and production costs, stripping away the layers of financial engineering that inflate Western prices. It is not that Chinese silver is no cheaper, because it is inferior. It is simply a reflection of a market operating closer to economic fundamentals. Now let's talk numbers, because your intelligent mind deserves precision. As of this year, China produces roughly 3,500 metric tons of silver annually, with a significant portion retained domestically for industrial and investment purposes. In contrast, COMEX reports daily trading volumes equivalent to hundreds of thousands of tons, far exceeding the real global supply. This discrepancy between physical silver and paper silver is why price distortions happen, and why an ounce of silver in China can appear shockingly inexpensive compared to New York. Another factor is currency manipulation and macroeconomic policy. The Chinese yuan operates under a managed system controlled by the People's Bank of China. This control allows domestic silver prices to remain stable, even when global markets experience volatility. In the United States, by contrast, the US dollar floats freely, influenced by interest rates, inflation expectations, and quantitative easing programs. When the Fed prints money or adjusts rates, the domestic purchasing power of the dollar shifts, and the silver price adjusts not purely because of supply and demand, but because of currency-driven speculation. We also need to consider industrial demand. China's manufacturing sector consumes massive amounts of silver for electronics, solar panels, and medical equipment. Unlike Western investors who often treat silver purely as a speculative asset, China treats it as both an industrial necessity and a store of value. This dual purpose keeps the domestic market grounded in reality. New York's market, by contrast, often reacts to financial signals, geopolitical fears, or hedge fund strategies, leading to spikes and crashes disconnected from actual metal flow. Now, here's where things get really fascinating for those paying close attention. When you compare these two markets side by side, you start to see patterns. Periods when the New York price surges often correspond with increased speculative activity or short-term hedging, while China's market remains stable or follows a much slower, production-driven trajectory. The gap between the two isn't random. It's a reflection of how differently each market is structured. Essentially, the West has created a system where silver behaves like digital money on paper, while China treats it as physical wealth with intrinsic value. So what does this mean for investors, especially those who understand data and trends? First, it reveals that the New York silver price is not an infallible indicator of market reality. Second, it exposes potential opportunities for arbitrage or strategic acquisition if one can access physical silver in markets less influenced by speculation. And third, it highlights a fundamental truth. Global silver pricing is no longer just about supply and demand. It's about financial engineering, policy control, and market psychology. In the next part, we're going to dig even deeper. We'll analyze real-time price discrepancies, historical data trends, and how these gaps can inform future market behavior. We'll also explore how savvy investors are leveraging these insights to protect wealth and anticipate shifts that most casual observers will never notice. By the end, you'll have a framework for understanding silver not just as a commodity, but as a window into the hidden mechanics of global finance. By now, we've painted the historical and structural backdrop of the silver market. New York dominated by paper contracts and speculation, and China operating closer to physical reality with government oversight and industrial demand. But for those who really want to understand the significance of $86 silver in China versus New York prices, we need to dig into the numbers, because data doesn't lie. Let's start with the current price spreads. At the time of this analysis, silver in New York is trading around $125 per ounce, while physical silver in China is available for $86 per ounce. That's nearly a 45% difference, a gap that would make any savvy investor stop and think. To put it in perspective, if you could theoretically purchase silver at China's price and sell it at New York rates, you'd be looking at an enormous arbitrage opportunity. Of course, real-world logistics, regulations, and shipping costs reduce feasibility, but the fact remains, the paper market in New York is significantly divorced from physical reality. Why does this happen? The first factor is futures contracts and ETFs. In New York, a single ounce of physical silver can back dozens of paper ounces, thanks to fractional reserve trading. What this means is that the price you see on COMEX doesn't just reflect supply. It reflects leverage, speculation, and institutional positioning. Meanwhile, in China, silver is largely bought and sold as an actual physical commodity, limiting the ability of speculation to distort price. Next, consider currency effects. The yuan is currently relatively stable, but any fluctuations are absorbed by China's monetary policy. This allows domestic silver prices to remain grounded near production costs. In the US, the dollar's value is more volatile, and that volatility directly impacts the silver price on paper. Even a small shift in the dollar index can translate to multiple dollars per ounce in the New York market, further inflating the apparent price gap. Historical patterns reinforce this divergence. Over the past decade, New York silver has shown sharp speculative spikes, often disconnected from physical supply constraints. In contrast, China's silver market has been remarkably steady, rising gradually in line with production and industrial demand. This tells us that the New York market is effectively a synthetic reflection of silver value, while China reflects the true grounded market. Now, let's talk about arbitrage. While direct cross-border arbitrage is complicated by regulations, taxes, and shipping costs, savvy investors look for indirect ways to exploit these discrepancies. For instance, some invest in physical silver ETFs that track Chinese markets or establish relationships with brokers in Asia who provide access to physical metal at lower relative prices. Others hedge against Western market volatility by holding silver purchased in yuan, which effectively preserves real-world purchasing power when COMEX prices spike. But here I assess the most fascinating insight. This price gap is more than just an opportunity. It is a warning signal. The inflated prices in New York suggest that the paper market is vulnerable. When physical demand surges, like during geopolitical crises, inflationary periods, or industrial shortages, the price of tangible silver could catch up rapidly, causing sudden sharp corrections in the paper markets. In other words, those who understand the data are not just looking for profit, they must be preparing for systemic shifts in global silver pricing. We can also visualize this with trends. If you plot New York silver prices against China's domestic market over the last 5 years, you'll see New York prices oscillate wildly, often diverging dramatically from China's more measured trajectory. The gap widens during periods of economic fear or speculative frenzy, exactly what we saw during the 2020 pandemic spike. Meanwhile, China's silver trajectory remains linear, reflecting real demand, production costs, and industrial consumption. Another key factor is industrial versus investment demand. Roughly 55% of global silver is consumed industrially, and China accounts for a massive chunk of that. When industrial demand surges, physical silver is locked into manufacturing, reducing supply for speculative investors. In contrast, New York OUS paper market can still inflate prices without immediate regard for physical supply, until a critical mass of investors suddenly demands delivery, which historically leads to market stress. This dynamic is why the West often experiences price volatility, while China's market remains resilient. Now, let's explore what this means practically. For intelligent investors, these gaps are not just numbers, they represent insights into market mechanics. Understanding the difference between paper and physical silver is akin to understanding the difference between financial theory and economic reality. Those who grasp this can anticipate market shocks, hedge intelligently, and even time their purchases to minimize risk. Finally, consider the global implications. The price gap between China and New York isn't just about silver. It reflects a larger trend in global finance, where centralized control and physical reality diverge from speculative markets. Commodities like silver, copper, and even rare earth metals show similar patterns. Recognizing these patterns allows investors to think strategically rather than reactively, and to see markets not as numbers on a screen, but as interconnected systems influenced by policy, production, and psychology. In the next part, we'll take this analysis further. We'll look at potential future scenarios, predictive insights, and strategic takeaways that intelligent investors can use to navigate a world where paper prices and physical reality are increasingly out of sync. We'll connect the dots between global policies, industrial demand, and speculative pressures to show exactly what this could mean for silver and the broader financial system in the coming years. Now that we've explored the historical context, structural divergences, and real-time data gaps between China and New York, it is time to ask the million-dollar question. What does this all mean for the future of silver and for those of us watching closely? Because here's the truth. The current landscape is not just unusual, it's a signal. A signal that global silver pricing may be on the cusp of a seismic shift, one that could rewrite the rules for investors, industrial users, and financial institutions alike. Let's begin with China's trajectory. Over the past decade, China has quietly accumulated silver through a combination of industrial demand, domestic purchases, and government-backed storage programs. Unlike speculative markets, this accumulation is tangible and persistent. If the West continues to rely heavily on paper silver, any sudden surge in physical demand, whether from industrial use, investor panic, or geopolitical disruption, could cause a dramatic realignment. Essentially, when physical demand eventually meets the inflated paper prices in New York, the market could experience sharp corrections, exposing the vulnerabilities of speculation-driven systems. Consider also the macroeconomic environment. Inflationary pressures, global debt levels, and fluctuating currency values are putting unprecedented stress on traditional financial markets. Silver, historically a hedge against currency devaluation and systemic instability, could become a primary refuge for wealth preservation, but only if investors understand the underlying mechanics. Those relying solely on New York prices may find themselves overpaying, while those aware of real production-based pricing, like China as $86 silver, can strategically position themselves to protect wealth and leverage arbitrage opportunities when possible. Another predictive insight comes from the supply-demand dynamic. Global silver production has plateaued in recent years, while industrial consumption, particularly in renewable energy and electronics, continues to rise. If industrial demand accelerates and speculative pressures remain unchecked in Western markets, we could see a widening divergence between paper and physical silver prices. In practical terms, this means market shocks, delivery squeezes, and potential volatility spikes, which historically have created enormous opportunities for those prepared to act intelligently. So, what should an informed investor or observer take away from this? First, understanding the structural difference between paper and physical silver markets is essential. Knowledge of how futures, ETFs, and derivatives distort New York pricing is not optional, it's foundational. Second, recognizing the stability and production-grounded nature of China as the silver market provides a lens to anticipate global price trends rather than reacting blindly. Third, the convergence, or potential divergence, of these markets can be leveraged to strategically hedge, preserve wealth, and time acquisitions. Let's talk about concrete strategies. For investors focused on physical wealth preservation, holding tangible silver, especially in markets insulated from speculative manipulation, can mitigate risk. For those interested in trading, monitoring the gap between China and New York prices, along with futures activity, provides signals for potential price movements and arbitrage timing. And for anyone looking at the broader picture, recognizing that global policies, currency strategies, and industrial demand all interact with silver markets offers a framework for predictive, data-driven decision-making. Beyond investment, there's a broader lesson here about understanding markets themselves. Many investors approach commodities like silver purely through the lens of short-term price movements. But as we've seen, the real story is far more complex. prices are shaped not just by supply and demand, but by policy, speculation, currency dynamics, and industrial realities. Those who comprehend this complexity are not only positioned to profit, they are positioned to navigate uncertainty with insight, turning what appears chaotic into a landscape of opportunity. Finally, let's consider the global implications. The $86 silver in China isn't just a market anomaly, it's a warning, a preview of how disconnected paper markets can be from physical reality. As the world continues to shift economically, politically, and technologically, the disparity between these systems may grow. Investors, analysts, and policymakers alike must understand these forces if they hope to predict and navigate future financial landscapes. Ignoring them is no longer an option. Recognizing them is a competitive advantage. In conclusion, the silver market today is a microcosm of broader economic truths. On one side, we have New York, dominated by speculation, futures contracts, and paper wealth. On the other, China, grounded in physical metal, industrial demand, and long-term accumulation. The price gap between 86 and 125 per ounce is not just a number. It is a window into the hidden mechanics of global finance, a call to action for anyone serious about understanding markets at their core. As we move forward, keep your focus on physical reality over paper illusions, data over speculation, and strategy over panic. Because when the gap between perception and reality narrows, the rewards and the lessons are enormous. And one final note. If this deep dive into silver markets, data analysis, and global strategy gave you new insights, hit that like button. It helps bring more high-level investigative content like this to viewers who are serious about understanding the world, not just following the headlines.